Today we are going to discuss our recently launched, actually just came out yesterday, Q2 2025 in review and mid-year outlook. Every quarter we come out with these. We cover a wide variety of domestic, international indicators, changes in portfolio management, 5 key questions on what we think is going to happen in the economy coming into the next quarter. And we also repost a blog we found pertinent and end our conversation on some annuity and structured note sales updates. For this quarter, it was violently sideways, we'll say, towards the end. On April 2nd, 2025, that became known as Liberation Day. Trump or the administration, unveiled a bunch of tariffs around the world, and we experienced a precipitous decline, 12-point peak to trough downturn. But since then, a lot of these deadlines were changed and a lot of the tariffs were dropped significantly, and we've been violently sideways, right? The S&P is up a little over 10% this quarter. We're looking at the NASDAQ that was up 16.5%. And we saw a wide variety also of political risks, whether that be India and Pakistan, and obviously Israel, U.S., and Iran conflicts. And we kind of end our quarter on what is the big, beautiful bill, which is going to be greatly stimulative in a lot of ways when we're looking at the extensions of the 2017 Tax Cuts and Jobs Act. And despite concerns of deficits, investors are definitely placated by the fact that, fiscal spend remains very strong, and we're going to continue to run some deficits and gin up the economy.
Yeah. Let me take it from here, Drew. Just look, everything is so important at the long end of the bond market, right? What matters to housing, what matters to how successful this OBBB will be, is going to in part depend on what the 10-year does. And the Treasury Secretary is very much aware of that. And he is saying anything and everything that he has to say in order to try to signal to the market that they are not going to let the 10-year get away from them. Whether it's various forms of yield curve control or managing long-term issuance, he wants to put a cap on the 10-year. And I wouldn't say it's working all that great right now. You've had, since the passage of the reconciliation bill, you have had the 10-year moving higher despite economic surprises being to the downside. So you do have more and more evidence that the economy is slowing a bit, but at the same time, you do have the 10-year moving higher. And I think it's partly just what the Fed has been talking about, that the fear is that we are going to, at the same time that we see economic growth slow a bit, you are going to see inflation accelerate. And that's what Street Consensus has modeled out through June, through July, August, and September. And there are a lot of very credible economists who think that the PCE is going to end the year well above 3%. On housing, look, housing is critical to the U.S. economy. Housing is slowing. It is slowing slowly. Housing prices are coming down. You actually do have a little bit more existing turnover as you get a little bit more existing supply. But the big concern that you have on housing is that, again, that rates are going to get away from you. Affordability is at all-time bads. And what happens if you start to see job losses in the critical cyclical housing market? One good thing about housing that housing has going for it is that the labor market is so tight, especially in housing services, that it's unlikely that you see a huge drawdown in the labor market as a result of housing, because I think a lot of people who are in the new construction market will end up moving into more of the kind of the home services areas. On energy and commodities, look, copper is obviously the story of the day with the president's 50% tariffs. Remember, we only get about 50% of the copper that we consume domestically, and that number is declining. There is no way we are going to rapidly increase our copper production in this country. It takes something on the order of 15 years to build a copper mine, and that's in places like Indonesia and Latin America. It might take a little bit longer in Nevada, making up a state. But most importantly, the oil market has been very much subdued. There, was a little bit of a scare that we got around the Mideast and Iran, but people don't seem to be concerned about that as much as they had been. That frankly surprises me. And oil is overall oversupplied right now. Look, Kazakhstan has been a much bigger producer. There is the promise that you are going to have really meaningful production out of Guyana. Obviously, the Middle East is currently overproducing, and the Saudis have decided, look, they're not just going to keep losing market share. So you do have U.S. onshore production actually starting to come down and the well count coming down. The part that people don't pay enough attention to is nat gas. Nat gas is pushing up closer to $4. That's been a big move this year, and that is going to show up in the inflation data as well. We are in a period where you have kind of a stagflationary outlook, where you have, I'm not saying we're calling for stagflation, but there's stagflationary pressures of less growth and greater inflation. And that historically is a very good period for energy and energy equities. On the Bitcoin side, look, if you like gold, you probably, and you're younger than me, you're under 50, you probably should like Bitcoin as well, right? If the whole world is printing money, and fiat currencies are just becoming less and less credible, then a currency that has a finite production, should have more value. Look, I don't quite understand, the excitement over stable coins, and all of the money that is moving into stable coins. Everybody needs to be a day trader, I guess, between different cryptocurrencies and so forth, and therefore they need stable coins. If you watch Visa and MasterCard trade, they're not exactly imploding. And that suggests to me that smart money still believes that the rails, the retail rails, are still going to be controlled by Visa and MasterCard, and that the implementation of stable coins and other kind of dollar-linked instruments are going to be a long time until they hit, if ever, hit maturation. So let's go into kind of the 5 key questions. We've hit on a little bit of this, but the 5 key questions for Q3 in the second half of the year is, number 1, is how stimulative is the big reconciliation bill going to be? It is only incrementally so much more stimulative, because so much of it is just a continuation of the 2017 TCJA, Tax Cuts and Jobs Act. So it is a continuation of those cuts. So the question is it additive to that? And I think it is additive to that. So you are adding fiscal stimulus to a long run period of excess fiscal stimulus, right? We have been running really crazy deficits without a recession since the kind of 2016, 2017 period, and it just keeps getting worse. So one of the arguments for why this economy has worked as well as it has, regardless of what the Fed's doing, is just because of the fiscal policy is just so loose. Think of it from the perspective of, in rough terms, we are going to collect $5 trillion in revenue. We're going to spend $7 trillion. We are literally overspending by 40% of our GDP. It's extraordinary. And there's an argument for, as long as that's the case, we're probably not going to have a recession, and we're probably not going to have a bear market. Now, those theories have kind of not yet been tested. If we do have a housing downturn, if the 10-year does get away from us, whatever that driver is, but I do think it sets us up for maybe some complacency. In other words, the economy has been so strong for so long with this big fiscal tailwind. If something does get in the way, that downdraft, that concept of escalator up, elevator down, might really show its head, because when you get into these periods of excess liquidity where everybody has convinced themselves that they're a master day trader, that usually ends badly. I don't have a time frame on when it ends badly, but I do think it ultimately does. The next question is to what degree will tariffs counteract all of the stimulus from the OBBB? And I think it will be significant, but I think it will be far more significant to the bottom half of the economy, to Americans who make less than $100,000 or $150,000 a year, because those are people that are going to consume everything that they earn. And that means that they are going to be paying the tariffs with all of their income, as opposed to somebody who makes $1 million and has savings. So the tariff only impacts the part of what they consume, which is only a small part of their overall income. So it is a very regressive tax. The question is, when do tariffs start to show up in the data? The tariffs are going to show up in the data. The foreign exporters sending products to the United States are not cutting the prices of those products, right? If you look at import prices, they are up, which means that the foreigners that send us these goods are not eating it, nor are the countries eating it through currency devaluation, given the fact that the dollar is down versus rest of world, our trade weighted basket. We talked about housing a little bit. Look, housing is critical. And the question is, does housing turn into a downturn in the second half? Our view on housing is that it's a drag and not a disaster. Our view, as I said a little bit earlier, is that, yeah, you could have some downside in housing. Affordability is really bad. Supply is increasing. Our view is on rates higher, but we do not foresee any kind of implosion, anything like what we saw in the great financial crisis. We do think housing will be a drag. We do think you will ultimately start to shed jobs in new construction as new construction falls. We do think that there will be a drag on consumer confidence to when half of the country has negative prices. Should that perpetuate across the whole country, it would be a much bigger drag. But as resilient as housing has been, with the great wealth transfer making a big impact on who is buying a house and the ability of young people, not particularly young, but mid-30s, to get into the housing market as facilitated by their generational wealth, I don't see a real negative, nasty downturn in housing, nor do we see the knock-on effects of housing-related job losses because the trades are just so damn tight. The next question is kind of global capital flight, right? When we had the big, nasty sell-off that we had in April of this year, at the very beginning of the second quarter, what people noticed about that is that it was equities down, it was Mag 7 down, it was dollar down, and it was treasuries down. So you didn't have the normal flight to safety into U.S. dollar and defensive U.S. dollar denominated assets. Look, the Mag 7, I just looked at this, is 60%. The market cap of just the Mag 7 is 60% of U.S. GDP. That is in every way unprecedented, right? NVIDIA alone is like 13% of the U.S. GDP, the market cap of NVIDIA. That requires this global flows into the United States. If you look at any pension fund manager in Europe, in Australia, in Japan, they are going to be very meaningfully overweight the U.S. They do not have 24%, which is what the U.S. is a percentage of global GDP, allocations to the U.S. They have much larger allocations to the U.S. dollar and much larger allocations to U.S. equities and so forth. Our only point is that the risk is that all that has to do is go lower. Portfolio managers and pension managers in Japan and Australia aren't going to turn around and say, all right, we're selling all our U.S. dollars, we're selling all of our S&P 500 exposure. No, but are they going to be less overexpressed in the U.S.? And I think that is the risk when you have as really meaningful a change as you have in U.S. policy The most important policy change being the idea that I think that we're kind of jawboning our way to a weak dollar policy, right? Scott Bessent, Stephen Moran have both talked about kind of the cost of our exorbitant privilege, the cost of our attracting all of this foreign direct investment being a excessively strong dollar. And I know if I'm an allocator of global capital, I'm going to be worried about having a huge overweight in a country that may really truly be interested in devaluing the currency. And look, if we're going to grow manufacturing, and we haven't yet, that is going to require a weaker dollar. I'm not saying that the dollar is going to collapse, but the dollar is pretty damn persistently weak here. And it's hard to imagine that that isn't, at least in part of the Mar-a-Lago Accord and the verbiage that comes out of this administration about the dollar. The last question, and here I think we're a little bit of a contrarian on the negative side, is will there be regime change in Iran? Look, our very simple observation is that it seems unlikely to us that Israel gets right to the doorstep of regime change in Iran and makes the decision that they're not going to move forward. Right? It has been the goal of the conservatives' leadership in Israel to effect regime change, to end the reign of the mullahs, and to try to beget an Iran that looks more like its population, which is younger, which is more global, which is well educated, which is cosmopolitan to some degree, right? And we'll see. My only point is that there will be disruption along the way, and in a world where sort of military warfare has been democratized, so to speak, where somebody with a few $1,000s worth of drones and explosives can make a very big impact on global trade. I find a lot of complacency around what happens going forward in Iran and in the Middle East overall. So let me turn it back to you with that, Drew.
Covered in our international segment, Europe and China in particular. You were just mentioning about the great, realignment, Tim, and we certainly saw that this quarter with European equities. Italy, there was up 16% roughly. If you look at broad-based Spanish index, that was up around 20, and then Germany's DAX was up about 20% as well. What's really happened is Europe broadly has become increasingly more comfortable running up deficits. Germany in particular, they've changed constitutional measures, and a lot of this will be going to defense spending. NATO has agreed to radically go from 2. It seems to be a lot of these countries are going to be hitting 5% of GDP. You have Poland and a couple Baltic countries that are already spending more on military in terms of GDP percent than the United States. And this is a trend that's going to continue. There's going to be a lot more fiscal spending. A lot of that is going to be in completely rearming and reindustrializing the continent in order to, offset some of the big threats that comes from Russia and that comes from elsewhere, but and primarily comes from Russia in terms of defending the continent. China, obviously has been characterized by the trade standoff between Donald Trump and Xi Jinping. Their property sector continues to be under some, terrific pressure. And we've also seen that their manufacturers declined for 3 consecutive months in June. They do have an immense amount of leverage in terms of negotiation with us, especially as a refiner, and really the primary global refiner of various critical minerals. A lot are used in, weaponry and then also quantum computing, pretty much the semiconductors, the technologies of the future. They're really a monopoly on the refining of these minerals, and that is where their leverage lies. Geopolitical risks, we always have a section on this. This one article, I was just to say, yes, geopolitical risks can matter, but oftentimes it doesn't. So we look at 20 major events in terms of, geopolitical crises. Often these are conflict-based. And for the most part, you're looking at, the stocks have median return a year after is up 8%. There was one big instance when we look at the Middle East in particular, which was when we're talking about 1973, the oil embargo that came, in the aftermath of the Yom Kippur War. Arab states were punitive towards any country that gave Israel material support. We saw massive declines in the stock market. But more recent history, whether we're talking about Gulf War I, the GWAT war that we're just getting out of, and if we're talking about what happened to Israel in the year aftermath of October 7th, Arab Spring, you name it, that didn't have any lingering effects on the stock market. So while these things can be interesting, while these things can be detrimental, oftentimes the markets don't roil, and they perform solid in the year after such geopolitical crisis. We ran a survey in terms of our portfolio analysis section, really showing two important things. We asked a bunch of respondents aged 45 to 75, kind of how important retirement planning was to them and how important it was to have a financial advisor that could create a guaranteed retirement income plan for them. Overwhelming response one was that investors thought that creating a guaranteed retirement income plan was very important to them, but also that had ramifications to the advisor, in that over 70% said that creating a retirement income plan with an advisor would then make them more likely to consolidate assets with that one advisor. So guaranteed income is really in the front of mind for people between 25 and 75%, and the offerings that financial advisors can create in terms of creating guaranteed plans and, private pensions, if you will, that means a lot to retail investors. Annuity updates, we saw the first quarter, we're a little bit behind in terms of LIMRA. They just came out with their first quarter reportings, but we saw that year over year came in the same as last year, which was a record. We've seen a lot of upticks in terms of VAs. A lot of that is coming from increased distribution amongst registered investment advisors. RILAs have ticked up as well. And economic uncertainty, especially in kind of the March, April side of the house, really made RILAs an attractive growth kind of protection balance play. And index strategies have made gains as well. And we continue to see that the majority of our top 20 FIA carriers, had sales growth. In terms of structured notes, we saw that industry participants were disappointed in terms of a lot of volatility. But as we kind of end the year, we think that a lot of structured notes linking to European indices, a lot of that has grown. And then we've had about $48.08 billion in structured notes sales year to date. But this comes from the last weekly structured notes bulletin ending in June 30th. So some more final numbers will be compiled. We lag a couple business days on this one. And with that, that was our quarterly 2 in review. We end with some insights and highlights that we had both in the podcasts and blogs that Tim's created. Really, I would be very appreciative if you took the time to read through the document and to send it to, any other advisors maybe in your branch or office that you think could benefit from this insight as well.
All right. Thank you, Drew.
Thanks, Tim.